Every month, roughly 32 million American households pay Comcast for internet. The average monthly bill is around $80. Some pay over $100. Most have no real alternative in their area. Comcast and Charter built their networks with the explicit goal of making competition structurally impossible. That model just started breaking. In 2025, Comcast lost 711,000 broadband subscribers. Charter lost over 400,000. Combined, the two largest cable companies in America shed more than 1.1 million home internet customers in a single year. Not in a recession. Not because of a price war, because customers found something better and left. And here is what makes this a SpaceX story, not just a cable story. When those 1.1 million customers were leaving, Starlink hadn't reached a single suburban market yet. The bleeding was happening before SpaceX's full competitive threat had even materialized. Jim Cramer said it out loud last week, and Cramer is not known for being early. I don't want to own AT&T or Verizon. Bernstein cut price targets across the entire telecom and cable group, Comcast, Charter, AT&T, Verizon, T-Mobile, because of one company, Space Exploration Technologies. This is the story of what happens to a $300 billion industry when the competitor disrupting it is funded by the largest IPO in history and has infrastructure already orbiting above every home in America. Let's establish exactly where things stand right now, because the numbers are worse than the headlines suggest. Comcast's stock is down 21.24% over the past year. The stock sits around $22 to $24, trading near its 52-week low. Goldman Sachs cut their price target to $26 last week. Morgan Stanley cut to $30. Wells Fargo trimmed to $28. Rosenblatt lowered to $24, noting the stock has now fallen 17% year-to-date, following a 56% decline in 2025 and a 14% drop in 2024. Read that again. Comcast fell 56% in 2025. That is not a stock having a bad quarter. That is a company whose investors have fundamentally repriced what it is worth in a world where its core business is in structural decline. Charter is worse. Charter's stock has fallen 67.45% over the past year and 37.37% year-to-date alone. Internet customer losses accelerated to 120,000 in Q1 2026. More than double the 59,000 it lost in Q1 2025. Q1 earnings per share of $9.17 missed the consensus estimate of $10.08. Charter carries roughly $94.3 billion in principal debt while simultaneously committing to a $250 billion five-year network upgrade program, roughly $23 to $24 billion per year, into a market that is structurally losing customers. Oppenheimer analyst Timothy Horan, the same analyst who removed his AT&T price target entirely last month, warned in March that new fiber builds could halt within 3 years as satellite pricing converges with terrestrial broadband. Charter's CEO Chris Winfrey acknowledged on the record during an earnings call that Starlink had gained penetration in some rural markets where Charter is building, requiring Charter to convert customers rather than enter a pure greenfield opportunity. That is a CEO telling investors in polished conference call language that the expansion playbook is broken. They are no longer entering new markets with no competition. They are entering markets where SpaceX got there first. Here is the part of this story that most financial media is not explaining properly. Everything described so far in the 1.1 million subscriber losses, the 56% stock decline, the analyst downgrades, all of this happened before Starlink had meaningfully penetrated suburban America. Starlink today has approximately 12 million global subscribers. Rosenblatt estimates that roughly 20% of those are in the United States, approximately 2 million U.S. households on Starlink. Against Comcast's 32 million U.S. broadband customers and Charter's 31 million, that's a rounding error. But Morgan Stanley now projects Comcast and Charter losing 400,000 to 500,000 broadband subscribers annually as Starlink scales. And that projection was made before SpaceX raised $75 billion in the largest IPO in history and announced plans to launch a direct retail mobile service for U.S. consumers. The central debate, as the 247 Wall Street report put it directly, is whether Starlink can expand beyond rural areas and become a serious broadband competitor in the suburbs. Longtime telecom analyst Craig Moffett argues the suburban leap will not happen. Bernstein cut price targets across the group anyway. Here is why the suburban debate matters more than anything else. Comcast and Charter's rural customers were always the most vulnerable, captive markets with no fiber alternative. As Starlink takes those customers, the company's network cost remains fixed while their revenue falls. Every subscriber lost in a rural area where the infrastructure is already built is pure margin erosion. But if Starlink moves into suburbs, and the analysis from telecompetitor project Starlink's US reach could top 30% of households, the scale of the threat changes completely. 30% of US households is roughly 40 million homes. Comcast and Charter serve 63 million combined. A 30% Starlink penetration scenario is not a niche disruption. That is an existential scenario. Of the two companies, Charter's position is the more immediately dangerous. Charter made two strategic bets that are now being stress-tested simultaneously. Bet 1, the Cox Communications acquisition. Approved by the FCC in February 2026, the merger created the largest cable operator in U.S. history, Charter plus Cox, covering more American homes than any single provider ever has. The logic was scale, bigger footprint, lower cost per home, more pricing power. The problem is that scale in a declining market doesn't solve the underlying problem. If customers are leaving regardless of which company serves them, getting bigger just means you lose more subscribers in absolute terms. Bet 2, the $250 billion Network Evolution Program. Charter has committed $23 to $24 billion per year through 2030 to upgrade its entire network to multi-gigabit capable infrastructure. The investment case is that speeds of 10 gigabits per second per home, compared to Starlink's current 100 to 350 megabits, creates a quality gap that satellite internet cannot close. That argument has merit for the segment of customers who genuinely need multi-gigabit speeds. The problem is that most residential broadband users do not need 10 gigabits. They need 200 megabits, reliably, without installation hassles, without 2-year contracts, without overage fees. That is exactly what Starlink delivers for $120 a month with no contract and no infrastructure visit. Charter CEO Chris Winfrey's conference call acknowledgement that SpaceX had reached rural markets first, markets Charter was spending capital to enter, is the data point that makes the $250 billion commitment look most exposed. You cannot build your way out of satellite competition with fiber. The economics are fundamentally different. Comcast's situation has a subplot that Charter's doesn't, and it changes the investment thesis significantly. On June 29th, Comcast announced plans to spin off NBCUniversal and Sky into a separate publicly traded company. The stock surged 19% on the announcement before nearly fully reversing the gains. The logic was straightforward. Separate the cash-generating broadband business from the underperforming media assets, give each management team a focused mandate, and let the market value them independently. Goldman Sachs cut their target to $26 from $29 2 days later, maintaining a neutral rating. The skepticism is not about the strategic logic of the spinoff. It is about whether a purer-play broadband entity can overcome structural headwinds from satellite competition even without the media drag. Here is what Comcast does have that Charter doesn't. Wireless momentum. Comcast added 435,000 wireless lines in Q1 2026, its best quarter ever, taking total wireless lines to 9.7 million. That is 16% penetration of its broadband customer base. The bundle strategy, selling Xfinity Internet and Xfinity Mobile together, reduces churn because customers are less likely to leave a provider they use for both home internet and their phone. The bearish case on Comcast is that wireless momentum cannot outrun broadband subscriber losses indefinitely. The bullish case is that a customer locked into both broadband and mobile with Comcast is significantly harder for Starlink to displace than a broadband-only customer. Starlink offers satellite internet. It does not yet offer a bundled mobile and home internet product at scale in suburban markets. That gap, bundled converged connectivity versus pure satellite internet, is the argument Comcast is betting $23 billion per year that it can defend. In 2025, Comcast and Charter lost 1.1 million broadband subscribers. Comcast stock fell 56%. Charter fell even further. Bernstein, Goldman, Morgan Stanley, Wells Fargo, and Rosenblatt have all cut price targets citing the same single variable, SpaceX's Starlink. And Starlink has approximately 2 million US subscribers right now. That is the situation before Starlink reaches the suburbs, before SpaceX spends the $75 billion it just raised. Before the direct retail mobile service Gwynne Shotwell described at the IPO roadshow actually launches. Jim Cramer said he doesn't want to own AT&T or Verizon. He didn't mention Comcast and Charter. Maybe he should have. Comcast earnings are on July 23rd. Charter earnings follow shortly after. Those reports are the first real numbers that tell us whether the subscriber loss trend is stabilizing or accelerating. That data lands in less than 2 weeks. This is SPCXLY, tracking every financial story the space economy creates, week by week, number by number.